Hey guys, welcome to this week's Money News in Human Words, where I'm helping you unpack the key themes behind the headlines and what they actually mean for you as investors. Now, the first piece from this week, and it all came at the back end of the week, was from the Fed, who have really spooked markets with their commentary around what their intentions are on fighting inflation. Basically, there was a big meeting over in the US. They came out saying that they're prepared to aggressively fight inflation, regardless of the cost to unemployment or the share market or the economy, because they see inflation as a real threat. And essentially, what that led to was $6 trillion being wiped off the value, or closing the month out for $6 trillion coming off the value of the stock market in the US alone. Which obviously a bit scary for investors. Look, the Federal Reserve work that they've been doing in the US has led to inflation starting to come down from the record high 9.1% to 8.5%. So they're sort of winning the battle, but there's still obviously a big way to go to get back to that target inflation band of like 2%. They're tipped to now raise interest rates by 0.75%, so another supersize rate increase tipped for next month in September, because people are still spending over in the US, driving or continuing to support inflation, mainly because of the fact that their unemployment rates are at record lows over there. But how long that spending can hold up is anyone's guess, and hopefully the Fed doesn't have to push too hard to bring that inflation under control, which they've said that they would do, because the more that they push, the slower the economy gets. And what happens in the US obviously filters through to us in Australia and to everywhere else in the world. The next piece that I was looking at in the news last week was around a record $102 billion of dividends due to be paid to Australian shareholders over this current financial year. That's a record level, up from a bit under $100 billion last year. And it goes to show that even when markets are going up and down, that there's a lot of protections in place for investors. If you're getting your dividend checks coming through and money that you can either spend or reinvest into the market, it means that when the capital values are coming down, so long as you're not forced to sell, you're still getting ahead. So these record dividend forecasts have come off the back of the Australian corporate earnings season, where we saw that despite higher interest rates, companies are still making good money and still ticking along, with unemployment at record lows in Australia being a big supporter of that, obviously. And I think that a lot of people get really nervous when we see market conditions like what we're facing today, which is natural. But in Australia, companies are really, really reluctant to cut their dividends. And that means that you've got a lot of protection. So when you keep investing, your dividends keep coming, even if the market is going sideways or going down. But it highlights the fact that when it comes to building your investment strategy, when you're getting started with your investing planning, that you need to be prepared for that and ready so that you're never forced to sell. That way you don't end up losing money as a result. Next piece, and sticking on a similar vein around investors, that wanted to unpack the three biggest risks for Aussie investors today. And they're not insignificant. The third one is a real sort of potential curveball there. But the first one is the property market. So at the moment, the property market is forecast to be come down by anywhere from 10 to 20 and upwards of 20% over the next little while. We just saw this big report released from ANZ last week talking about values declining. But at the same time, we've seen that the premium suburbs, the top end of the property market, is still growing, even though the property market is softening, and leads to a lot of people sort of questioning these forecasts. And we saw, going into COVID, the banks were saying that there was going to be this property crisis and property values are going to go down 30, 40%. That didn't happen. And in fact, we saw the opposite of that happen with record growth in the property market. Then just as recently as the back end of last year, a lot of the banks were talking about the property market continuing to grow through 2022 at the same rate that it had in 2021, which obviously hasn't happened. So you sort of question, how accurate are these forecasts? But look, when people's wealth goes down, like when property values go down, it means overall people's wealth is going down. And when people don't have as much wealth, then they sort of pull back. They obviously pull back on their investing, but they pull back on their spending behavior as well. So that does filter through to the economy, and definitely a big one to watch. The second big risk is zombie companies being wound up off the back of these raises to interest rates. Now, throughout the last couple of years, we've seen ultra low record interest rates, and a lot of companies have built business models wrongly around the assumption that interest rates would continue to be low for an extended period of time. Now that that's not happening, it means that a lot of companies are put under risk because they can't access this cheap debt. They've got flawed business models, and it means that they're going to have to refinance, which is going to be quite challenging in the current market. As these companies start to default and be wound up, then that starts impacting business confidence. It starts impacting business financing, which has a multiplier effect that if people start pulling back from lending money to businesses, it means that even good businesses can't continue to grow, and that creates a serious risk. The third one, though, and this is probably the scariest one for me, is around the potential for China to invade Taiwan. There's been a little bit of talk of that, which has been increasing in recent times. They've been talking about this for years, but they're saying that the potential for that to happen is increasing now. Now, we obviously China didn't like the visits from the US politicians, and they've been ramping up their activity as a result. I shouldn't really laugh because it is quite serious, and the CIA do a heap of commentary around this stuff, and they've just said that they have noted that the chances of these things are increasing over the next little bit. They're talking about potentially China invading while Joe Biden is in power, partly because they don't want to wait until they potentially don't want to wait until the next president is in place, because they've shown that Biden is a little slower with his decision making. And because China are intending to invade Taiwan and wrap it up quite quickly, it means that potentially if someone's slow off the blocks, then they could have it wrapped up before they know it. There's also been this big gap that's created between the US and Chinese defense tech, which is now starting to close. It's mainly been as a result of the US not being as focused on it as China. But as that gap then shrinks, then it makes it less appealing for China to potentially invade. And the other piece is before a new government comes in over in the US, where China feels that potentially if a Democrat gets back in, that could mean a more aggressive stance and be potentially worse for them when it comes to that. So I think that the commentary that I've read at least suggests that China may have picked up some tips from Russia around this. Obviously, this is something, or maybe not obviously, but this would be quite bad for markets. We saw, like when the Russia-Ukraine conflict kicked off, that was really one of the big catalysts for markets tanking in the shorter term. And particularly with China and the US being two massive superpowers, massive economies, massive investment markets, that there is a bit of risk. Now, these things do tend to be short term, and looking at history shows us that geopolitical risks like this, or geopolitical conflicts, don't have a sustained impact on markets, but it does create a short-term impact. So it's really important, I think, in light of this and the other risks that I've mentioned as well, that investors are really smart with how they tackle things. Time does de-risk all risks. So I'm not a believer of sitting on the sidelines waiting for everything to be rosy, because that potentially never will happen. But knowing that you've got a rock solid plan so that you can benefit from the power of time means that you're not going to get caught short when things are volatile in the shorter term. Changing gears a little bit, I wanted to talk about the Superfund reforms that have been proposed over the last week. The dawn of superannuation. Paul Keating came out, and there was a lot of talk and activity happening. He came out with Treasurer Jim Chalmers. They talked about doing some of the biggest reforms to superannuation, I think, ever since it was launched, essentially. And they talk about the fact that there's now this $3.4 trillion pot of money that's sitting in the Australian superannuation system, that they're spoken about the fact that they think that this money should be directed to helping with the nation building that's happening in Australia, particularly the support in the transition to renewable energy, as well as to create cheaper housing. Now, critics of this policy including myself, I have to say for the record, say that pushing funds to invest in anything as opposed to just letting the free markets decide where capital is best placed is really disruptive to our current sort of paradigm when it comes to the economy and our capital market. So in my view, I think it's a bad idea. As much as those initiatives sound like great initiatives and things that are important for the country, in my view, the government would be better placed to set up these programs in a way to make it compelling for capital markets to support things like the transition to renewable energy or the more affordable housing, as opposed to forcing superannuation funds to invest there. Things like funding businesses, where they talked about raising the cap of how much superannuation money is used to finance companies through bonds and debt from the current rate of 1% to 10%. No surprises that Andrew Pratt, the head of Visy, came out is staunchly advocating that because he's happy to have more options to borrow money. But in my view, there's drastic implications for the long-term returns on these alternative type investments, given that so much of the superannuation money in Australia currently sits in default options. In my view, this could be a real disaster for Aussies. As I say, I think that they're all noble pursuits, but having it set up in a way so that super funds aren't compelled to support these projects, setting them up in a way so that they're so compelling that people want them is, in my view, a better way to get to the same outcome. Another interesting piece I was looking at last week was on the average super balances that came out. The Superfund statistics show that for the average 30 to 34-year-old in Australia, the superannuation balance is 48,000 for males, 40,000 for females. For 40 to 44, it's 80,000 females and just under 100,000 for males, which compares to recent data that we looked at showing that there's like 800 Australians under the age of 40 that have more than $2 million in their super, and there's a ton of Aussies under 30 that have $5.3 million in their super fund. Now, I suppose the question is, how do you compare? And comparing isn't the be all and end all. In fact, what other people are doing with their money shouldn't really impact what you're doing too much. But looking at how you compare, and I'd encourage you to check out the data online and see how you are tracking. Because if you're running on average, then you know that you sort of around the money. If you're behind, you might recognize that you might want to do something more if you want to close that gap. Or if you're running ahead of what the average is, if you're happy to, it might mean that you can take your foot off the pedal a little bit and enjoy the day-to-day a bit more, knowing that you're still on track to end up in a good spot with that stuff. So you can check out that data online. Makes for some pretty interesting reading, at least for a money nerd like me. Now, changing tack a little bit, I put out some content last week on the top 5 things that I would never do to build wealth. And I thought it was worth sharing them here because I got a lot of feedback and comments from people around this. Now, the first one is about buying property off the plan. In my view, that comes with a lot of risk, particularly like what we're seeing at the moment where interest rates are increasing, property market softening. If you contracted to buy a property off the plan 6 or 12 months ago and it's going to complete over the next 6 or 12 months and you have to pay when that property completes, you're probably pretty nervous right now, waiting to see what happens with property values, waiting to see what happens with interest rates, waiting to see what happens with your ability to get a mortgage at that time. So in my view, the risk is probably worth more than the potential benefit, and you can definitely benefit from doing this. A lot of great stories out there about people that have made a bunch of money going down this path, and obviously this is just my view, but I feel that the risk is worth more than just buying something that is completed, what the mortgage market looks like, what the property values are, and you can just go out and get it done, making sure that it fits in with your plan and you've got your risks covered without the stress. The second is about not having all of your investments in one place, whether that's shares, property, crypto, cash, superannuation. I think diversification is important. It's something people talk about in investment markets, but even though I love property and I think property is the most effective way to build wealth because of the gearing impact that you get with money, with property, I wouldn't put all my money into property because it's more stressful and more risky than having it spread across different buckets. The third thing is not using a budget. And I don't mean about counting every dollar or restricting yourself massively, but making money decisions without having a solid budget in place where you're super, super confident on your numbers, particularly when you're borrowing money to buy property and to invest into property. Super scary, and you can end up making a bad decision. When you've got a rock solid budget, allows you to know what the right thing is and to do it with a lot of confidence. The fourth thing is not ignoring property, and I touch on property a couple of times. I saw some crazy content out on the weekend saying that shares are better than property because of the income on property or something like that. But the reality is that if you're still in the process of building wealth, when you buy a property, you use a small amount of money, which is a deposit, to go and buy a bigger asset, and then you've got a bigger asset working for you. Now, I don't care how good your share portfolio is, it's never going to compete with an asset that's 5 times the size or more. So I think you ignore property at your peril when it comes to your wealth building. The fifth thing is investing based on the headlines. And I love unpacking the headlines through this podcast, but you run a ton of risk if you're reactive, if you're making reactive decisions around your investing, no matter what you're investing in. I mentioned earlier that time de-risks all risk, and that's something that is really important, that if you're making reactive decisions and if you're selling more frequently, that means that you've got more chance of losing money, and that can be a real problem. So don't invest in the headlines, ignore those risks, and don't ignore those risks. And if you, if that resonates, you can probably put those into your arsenal and avoid some of the hassles and get there. Now, one little piece of motivation to leave you with, I started looking last week about when you leave your different decades of your life with different levels of investment. So starting with your 20s, I looked at if you leave your 20s with $5,000 of investments, it would be worth $75,000 by the time you reach age 60. If you leave your 20s with $50,000 of investments, it would be worth $757,000 by age 60. If you leave with $100,000 you leave your 20s with $100,000 in investments, to be worth $1.5 million by age 60. Now, a lot of people talk about the fact that how do you get $100,000 in your 20s? And I get that that's it's not a small amount of money, but when you break it down, that is just investing $18 per day or $126 per week. Again, I get that could be a challenge for most people, but $18 is a reasonably small amount of money. There's a couple of lattes, depending on where you buy your lattes. And to get you, $100,000 that will then grow to $1.5 million, I think that's a pretty good deal. So, guys, that's it for me for this week. I hope you've enjoyed that.